Welcome to the Down to South London podcast. My name's Jeroen Hoppe. I'm a South London property investor, and the Down to South London podcast is all about investing in South London. Today I'm joined by Sharma of Finura Developments. He's going to tell us a little bit more about the investments that he's made in South London. So Ro, why don't you kick us off and tell us who you are and what you've been doing?
Sure. I've been working in property development full time for about a year and a half to 2 years now. I decided to make the change from the corporate world. I worked for a bank, did a bit of time in management consulting as well. So my corporate history was risk management, project management, and change management. Prior to my time in the banking space, I was an army officer with Royal Engineers, where I served for about 9 years. Worked in a few places around the UK, based overseas, and some operational tour experience as well, and had a great time. But having made those various transitions, I got to the point where I realised actually it'd be great to be working for myself and building my own capability in business. So I chose property, having had an interest in that space for quite some time.
That's massive. So your main interest for switching career is just a passion for property, or what was it that prompted you to go?
Yeah, there's a couple of things actually. I worked for a couple of quite large institutions, as I've mentioned. You always played a very small part in a very large machine. Had a great time, learned a hell of a lot, really good experience, travelled the world, worked with some really cool people in some really interesting places. But I had a background interest in property as well. Bought my first buy-to-let in like 2006, 2007, something like that. Having kind of had that seed planted there, having had that interest, as I kind of went through my corporate career, I realised that actually, even though I'm great at working with big teams, I've always had that inner entrepreneur that was fighting its way out. So I thought it'd be great to actually use those learnings and that experience to build something for myself. And already having that interest in property and having invested in a lot of education in terms of time, I thought actually that's a great way to do it.
That's amazing. So that's a big transition from being, as you say, a small cog in a big machine to, well, literally spinning all the cogs yourself, I guess. So you told me about your HMO investment. I've actually been to see your previous projects. What was it about housing multiple occupation that attracted you to think, well, this is a path I want to go down, this is a fruitful course, let me do another one?
Yeah, sure. So, progressing from single lets, I thought, okay, how can we generate more income more quickly? So it was actually working with my partner now, my wife Louise. We decided it'd be great to embark on a journey where we could get some education. So Louise actually did a course with a great guy, Trevor Cutmore, who I know you know well as well. He did a mentorship program where Louise was involved in, and that kind of gave us the ground or the base knowledge really to define a strategy that would work for us. And HMO seemed like a great place to start because they give you higher cash flow, much greater yields. There's a little bit more work involved up front to get them set up. We thought that'd be a great way to actually enter the market, to start generating passive income and cash flow, which we could then build upon for other types of projects further down the line.
Passive income is very powerful, isn't it? So if I understand this right, you chose the strategy mainly because it's a lot of work up front, and then you can sort of, you go hands off, don't you? You have it managed.
Yeah, so the idea was take on projects, so we do that work exactly as you say up front, do all the detailed work into the planning to get them set up, and then actually work with the appropriate agents that have HMO management experience to actually manage those for the long term. So in theory, if you set them up right and you're working with the right partners, then absolutely you can take more of a step back, and it's just more a case of having to dip in every now and then if there's any major maintenance issues or anything else that you have to deal with. But primarily our business model centres around outsourcing the management for the long term, so that, as you say, it can allow you to have that kind of passive income being generated for the long term.
Absolutely. So I think the crux of it is you create the value from the start, don't you? So you buy cheap, you refurbish, you add value, and you finance out. It's not too dissimilar to the strategy that I use for the flats that I buy. But what type of properties do you normally buy? What do you go for?
So typically I look for houses that can easily be reconfigured. So typically it'd be the sort of thing that has a few bedrooms upstairs and some decent sized rooms downstairs, which you can easily convert subject to meeting the minimum space requirements and all the other things that the HMO legislation require of you when you're converting a property. So typically it'll be like a Victorian property because they tend to be quite large, and you can reutilise the space in there quite easily. Quite often you need to do a little bit more than just sticking a few fire doors on. There's a whole scope of works that has to be considered as well, such as upgrading electrics, the plumbing, the fire systems, soundproofing, thermal upgrades, as well as making sure you meet the minimum amenity and space standards for communal areas and that sort of thing. So there's quite a bit to think about.
This isn't just a back to brick, it's you're redesigning the whole space. I mean, you summed it up quite well, and you summed that up within 30 seconds, but I've seen what you do. And if you ever have a look at any of Ro's projects on social media, be it LinkedIn or YouTube or what have you, you'll see that the sheer amount of work that goes into his projects is absolutely unbelievable. We're talking RSJs here, extensions there, extra toilets going in here, showers in cupboards and things like that. Big cupboards, mind you, and it's definitely not a beds and sheds sort of thing. They're really good quality. But hats off to you to reconfigure that, not only on paper, but to execute it in real life as well. It's absolutely amazing.
It's hard work. It takes a lot of planning, but because we're investing for the long term as well, we find it makes more sense to invest more up front, to really go through the detail of upgrading everything so that it's going to last for the long run. Because you will see a lot of developers and HMO investors, for example, who can achieve the outcome far quicker and far less cost up front. Which can work, but I think because of the changes in regulations and compliance, because you have to meet so many requirements, in terms of sound, fire protection, we wanted to build a portfolio of properties that are actually built to last, so there's going to be minimal maintenance costs in the short term. So that's why we go that extra mile now. You've got to strike that balance between spending too much up front to make sure that it stacks up at the end, but because we have minimum criteria in terms of what sort of return the asset needs to be generating once it's actually been filled, we work out roughly what our tolerance is in terms of how much we can afford to spend on it, and that's a really important part because the deal has to stack, and if it goes well over budget, then that can affect the residual income that's going to result at the end of it, and your yields and your return on capital employed.
Absolutely. And as you found on the previous project, if you haven't been following Ro at all, his previous project actually was very challenging, and his builder actually went bust during the build. Now, that obviously hurt your yield. I'm sure it did. It can't not have done. How did you recover?
Yeah. So our very first project was something that we thought, let's go for the biggest project that we can take on that was within our sort of risk tolerance levels, and we did some really detailed planning because the idea was to get credibility, get a really good project under our belt so that we could open the doors for bridging finance and also to attract investment for future projects and really kind of build something that could really push and challenge us. Louise and I, we love a challenge.
You certainly had one when the builder walked off.
Well, so what happened in terms of background was, we took what was a 2-bed mid-terrace house in South London, effectively 2 up, 2 down, or 2 up, 2 down. We took the roof off of it, so we built 2 more ensuite bedrooms up on the top floor. We did a single-story rear extension. We stripped the house back to brick. We reconfigured inside, rewired, replumbed, put in 5 bathrooms, new kitchen. The works and everything had to be compliant.
And a tidal split, so the shed in the garden became a tower block as well, right?
So we really did maximise that property.
Yeah, you certainly did.
What we were looking to achieve out of it was a 6-bed, high-quality, high-end HMO for young professionals, which fortunately we achieved. But to your point, we did our risk assessment up front, and the one thing that we didn't factor in was the potential for the builder to go bust. And unfortunately, that was the one thing that did happen. There were a number of key learnings from that. Was that effectively the contractor had taken on something that was far bigger than they were actually capable of achieving. Now, we did all the due diligence on them, got references, saw other work, and all the other things that you should do when you're choosing which builder to work with. So I think with the knowledge we had at the time, we did as much due diligence as anyone could have done, even as far as looking at financial records, company's house, that sort of thing. I knew there was it was going to be slightly bigger than what they were used to doing, but I did feel it was within their capability, and it was technically. It's just unfortunately they ran into cash flow problems because they had too many jobs running at the same time and actually weren't putting enough attention on the job as it was, and unfortunately a lot of things had to be redone at their cost because they were starting to go a bit off-piste. I was working full time at the time, and I think perhaps one of the biggest learnings for me was I wasn't spending enough time on site as they were going through the journey, even though it got off to a great start. Now, in terms of the cost, that ended up costing in total probably what it should have cost for a job of that magnitude. I think both we and the contractor had underestimated the scale of work that had been involved.
Right.
Now, when the contractor went through their CVO, which is a creditor's voluntary liquidation, effectively them going bust, what happened was that we probably hadn't spent too much more than we should have done by that point, but we lost a lot of time. So effectively I ended up managing the project myself, bringing in my own tradespeople, my own plumber, my own electrician, managed to salvage a couple of the original core builders from that original team, but I had like a proper multinational team. I had Albanians, I had Jamaicans, I had Polish, I had English, I had, I'm sure there's a couple other nationalities that were in there.
Well, thank God the
as
Brexit
well.
effect hadn't taken full force.
Exactly. But because I was managing it myself and using my military, my project management skills, and really working my network to bring in the right people to help advise so that we could get it done properly, the outcome was that we didn't actually lose a huge amount of money on it, but we lost a bit of time. So what should have been about 6 months turned into about 9 months, but also is a huge cost of my own personal time. So even though it cost me in time, the knowledge and the experience and the confidence that it gave me were absolutely priceless. But to your original point, were we still achieving the end outcome of the yield that we'd calculated up front? Well, actually we did, because we ended up getting a much higher valuation than we had sort of factored in. And even though the build cost had gone up, actually the end valuation was up an equivalent level as well, which meant that when it came to refinancing, it still fit the model exactly as we'd predicted or as we'd created within our financial model up front. So that was great, and that's an asset which is performing at 20% plus, that's return on capital employed in terms of the money that's left in the deal. So actually I couldn't be more pleased with the outcome of it, even though it was a bit more painful and a few more grey hairs, that were produced as a result of the experience, but actually gave a huge amount of confidence and enabled me to do what I'm doing today, which is actually
good, and that's valuable in itself, isn't it? That's worth actually paying money for. But it sounds like things worked out. You got the high valuation to compensate for the overspend in time and money, and as you say, it wasn't really an overspend. You'd under budgeted, really. Yeah. You spent what you should have spent in the end. Yeah. So, no, it worked out. So tell me how you're a Battersea man. What prompted you to invest locally in South London? Because you hear on the networks, everyone's going, "Oh, the yields are fantastic up north. You must go to Sunderland or Manchester." Or what's prompted you to stay local?
Yeah, so two things really. I mean, you're absolutely right. Two of the key considerations that investors always make are or give are potential for capital growth, and then what's their cash flow going to be. So what we wanted to try and achieve as best as we could was a blend of those two outcomes. And coupling that with a risk management strategy, we thought, okay, we want something that's going to be not too far away. Now, when we started this journey for looking for properties to turn to HMOs, Louise was on a career break, and she was doing the Table of 12 course with Trevor, and she identified two key areas that we thought could work quite well. One of them being East London and the sort of Stratford area, with the post-Olympics boom and the rest of it. We still identified lots of opportunity there. And the second one was Croydon. Now, what we found was it was taking a long time to travel backwards and forwards to Stratford, and actually it was much quicker and much more time efficient for us to focus on the Croydon area in South London. So we thought, okay, as part of being able to manage projects and the risk, we thought let's stick to an area that's close enough for us to do lots of viewings, understand the area, understand the market dynamics, and somewhere where we feel we can still get the right level of cash flow and yield, but also it's going to be a bit more robust for us in the long term in terms of capital growth. And London, in South London being our patch, you can't go wrong because there's just simply not enough quality housing, and there will always be a demand because it's fundamentally an undersupply. So a combination of three factors really: cash flow, capital growth, and obviously from risk management being able to react to it. So that's what drove our decision.
Yeah, people just underestimate the petrol money and the time factor, don't they? And people say, oh, but you can get properties remotely managed, and you even get it managed, even though you're on hand, you can deal with it. But for you, it's more about doing the project and the letting and the management side, you kind of outsource because that's not your area of interest. It could be an area of expertise if you focused on it, I'm sure, but you prefer to focus on the adding value.
Yeah, absolutely. I think one of those things when you're building a business, as you build scale, you can start perhaps insourcing if you need to, but in the early stages, you've got to leverage other people's expertise and their capabilities as far as you can to make it more efficient on your time. So that's why we've outsourced it. Our vision is to build a portfolio where perhaps we have an in-house management capability, and then perhaps at some point, once you've got a portfolio which is an operating business, you've got an entity which has a lot of intrinsic value in it as well, which can potentially be sold on. You could have a couple of portfolios. You sell one portfolio to deleverage the other one. So perhaps that's something we'll be looking at. But at the moment, outsourcing is the way to do it.
Yeah, it's great, isn't it? The building a portfolio to then sell on. It comes back to what we were saying before the cameras were rolling. When I interviewed someone else, they told me they had a loan to value of 40 to 50%, and obviously very envious of that because you were in a position of great expertise, great experience, and over the course of your career, you do deleverage, don't you?
Yeah.
As you get older, as you get more advanced, you think, okay, well, I don't need to do risky deals, I don't need to leverage up so much, I'll reduce my borrowing, reduces your exposure and things like that. And especially when it comes to commercial loans, if your loan to value drops below X or whatever they've got in there, they've got the option to call in some money in order for you to reduce that loan to value, and people don't really think about that. That could be around the corner. If you've got a portfolio sitting on 75% loan to value and the market drops by 10%, hey, you've got to cough up quite a bit to make that good, haven't you?
Absolutely, and I think now is a tricky time to be entering the market because, especially, going back to your point about whether you invest up in the north or in the south. I mean, I know lots of people who are doing tremendously well with building portfolios in the north, and that's great. Obviously, there are fewer barriers to entry in terms of capital requirements and how much of a deposit or cash you need to have up front. Obviously, when you're investing down in the south, and in London particularly, there's a lot more capital intensive or equity intensive. You need to have that cash that you need to put in yourself to better, to acquire or control those assets, because the banks will only ever leverage to a certain level. Now, at the beginning of any business growth journey, the biggest risks tend to be up front where you're investing, so you probably are going to find you're more highly leveraged. But the idea over time is to de-risk, whether that be through capital growth or by paying down on your loans or whatever it may be. But typically speaking, the risk is at the beginning where you have a higher leverage, and then the strategy should always be to deleverage with time. So I think the example you gave of the other person you spoke to, if you've got a 40 to 50% leverage across the portfolio, that's a great place to be, but it's much harder to start off with that position now. I don't even know if that was possible before.
Absolutely. Well, it comes with time, experience, and it's just a journey, isn't it? I think he'd been in the game for a lot longer than me and you have, and it's always valuable to look up to people who've been doing it for a longer period of time, see what they do, and you learn from your elders, don't you?
Yeah,
the people that have walked the walk already.
Yeah.
And that's why these conversations are always interesting, because they were able to do things in property at a different time. For example, the whole same-day remortgage thing back before the pop in 2007. That was a thing. If you and me were investing back then, hey, we wouldn't be sitting here. We'd be sipping pina colada somewhere, wouldn't we? But yeah, we do the best with what we're given in the time that we've been given. So.
Yeah. I think today it's very much about risk management as well. You have to understand exactly what those risks are, whether it be market risk, it's got to be the construction, the execution risk, you've got the credit risk, you've got all these different risks you need to be really mindful of, and you need to have strategies to mitigate them, because there are so many things that are happening in today's marketplace that there's a huge amount of uncertainty there, but that obviously creates the opportunity for people who've got the right risk appetite to enter the market now. So I do see there being tremendous opportunities to do deals with people when deals have to be done. People will only sell in today's market if they have to.
If they really have to, that's
and
it.
if they do, there's a deal to be done.
And you know what, you and me, I'm sure we've learned a lot of things from the pop in 2007, and over the time that the market's recovered, and all the banks are doing more due diligence, borrowing is a lot stricter, and as a result, you know you can't get finance as quickly as you could 15 years ago.
Yeah.
You're doing a lot more internal checks as well.
Yeah.
You're thinking like a bank. You're
Yeah.
thinking more diligently. You're thinking harder. You're thinking smarter about where to employ your capital.
Yeah.
And that's ultimately going to make us better investors.
Yeah, definitely. And I think one thing that really helps us today as well is the strength and power of the networks as well. We've got so many communities online, whether it be on Facebook, through LinkedIn, as well as a huge physical networking events that take place. And you and I are part of a number of communities as well, where the amount of knowledge that's out there is just absolutely fantastic, because it really equips you and arms you with what you need to know before you start making decisions that carry any risk. And that means that people can really go into transactions, or at least the knowledge is out there in a way that it probably hasn't been historically, to really de-risk whatever your investment strategy is. And that's been so powerful and a really critical part of our learning journey as well. And it's enabled us to take on more projects, put more offers out there, use more creative deal structures to mitigate the risk on all parts. Using the right legal structures, the right tax structures with the right accountants, and having those right professional players available, or the power team as they call it. And I think that is a great way of making a success of any property investment journey today, even when we are in uncertain times.
Definitely. That kind of answered my next question as to what gave you the confidence to do all that investment. But as you quite rightly say, there's so much support out there, the Facebook groups, the YouTube videos. There's many property people that are documenting their journey, and even I've picked up loads of stuff that I didn't know from these videos. And you don't have to go on a £20,000 course to pick up stuff. I mean, I'm not knocking any course. I think there's a lot of education out there that is very valuable to to people to package up. And you go to university, you pay £20,000 in fees quite easily.
Yeah.
Whereas you can get a book and read it all, but you follow a set format, and there's a format for success, isn't there? And then there's the application afterwards. We are both clear examples of actually applying the knowledge. Which leads me to my next question. Which are the three most important things that you've used in your sort of journey? Resources or anything at all, really?
Yeah. I think the first thing is knowledge and confidence. And I think, as we've touched upon, the networks, whether it be online or through the communities that we're all part of, that's been a key factor. You can't really enter any form of transaction or strategy until you've really researched what you're going to do and what the risks are. So I think that's the first thing. I think I'm fortunate in having a risk and a project management background, and that's really key, because you don't need to know the answers to everything. You just need to know where to find those answers and who to pull in, which expertise you need to draw upon. And you need to be able to recognise problems in advance, rather than being hit with them at a high speed collision. In slow motion, if you can see something coming, you can react to it. And that's actually, even when I talk about my the previous project where the contractor went out of business, we could see it coming for a couple of months. So actually we were able to put a lot of measures in place so that we could just very easily take the reins as soon as that happened to continue the project through. So I think that's been really important for me. Networks, the project and risk management kind of mindset, and anyone can develop that through the knowledge as well, and through the networks. And I think the third thing is probably just, again, very much linked to the networks, is having the right contacts when things do go wrong, knowing who to speak to or who to pull in, knowing which plumbers are good, which electricians are good, which structural engineers are good, who you can call upon to help you to solve problems quickly and react. I think those are probably three key things, and probably, if I have to add a fourth, you just need to be mindful of the financial returns and risk reward weigh up of what you're doing, and make sure you've really understood what you're trying to get out of it. Because I think a lot of things you see online make it sound very easy to achieve certain outcomes, but you just need to make sure you do your
You never hear about the negatives, do you?
Yeah.
You never hear people boasting, "Oh, I've gone bust today."
Yeah, and actually that's something I'm very keen to do. I'm starting to do a bit more on social media, where I want to show everyone what I've been doing, how I've been doing it, the highs as well as the lows, because it's not an easy path. I took the move from the corporate world into what I'm doing now. Quite openly, I I haven't replaced my salary of what it used to be, but I'm on a trajectory, and I can see how I'm going to achieve that end goal. And even once I punch through what I used to earn in the city, I can see that actually it will just keep on growing quite easily. And
it's passive, really, isn't it? So.
Yeah, it will be a combination of the passive income. I'm actually doing two things. So I've got like a long-term income generation strategy, which is through the HMOs and the co-living, so high-end shared living in South London. But my second strategy is more of a liquidity strategy, and that's going to be more around doing joint ventures and developments, title splits and flips. So buy, do up, sell, put it back out on the market, taking sort of the large illiquid property assets, turning them to sort of things that are far more liquid and more appealing to first-time buyers, for example, where there's always going to be a demand for those. So doing a combination of the two, generating lumps of capital through developments, reinvesting some of that through into long-term income generation, because obviously, when you're building a buy-to-let or HMO investment portfolio, that's always going to be capital intensive. Obviously, as I said, in London, you end up having to put more into properties here in the right areas. You put less up into them up in the north, say, but actually, you're still getting equivalent returns. So I only need to do maybe like 1 or 2 transactions down here, where I probably need to do 4 or 5 or 6 in a lower value area in the north. So that's kind of what I'll be doing over the coming years as part of my journey.
Good. Is there anything that you're working on right now that you want to share with us?
Yeah, so my current project is an 8-person HMO project as well, in the same vicinity as my last project. That's kind of nearing completion, probably got about 3 weeks left on that. I've got the next project lined up for after that as well, which will be another co-living HMO type of project in a similar area, and that's a great deal which I've been able to secure in the last few weeks. I've also recently had an airspace development project which has been agreed, which I'm going to be joint venturing with a family member actually, who has a design and build construction background. So we're looking to do that. That's probably going to be more of a slow burner, because we've got a few more bits we want to put into the mix for that to really de-risk that and make that worth our while. So probably 3 in the pipeline for this year, and then I think once those are secured, those next 2, I'll probably look at bringing some more into the mix and continue growing gradually rather than trying to take on too much too soon, because no matter what people say, there's a lot of stress involved in this game, but once you know how to manage those risks and get through it, you can really see the light at the end, and I'm at that point now where I can see the trajectory and how I want to achieve that.
That's amazing. You've achieved that in a fairly short space of time, I suppose. You said you only started in property development about 1.5 to 2 years ago, and that's amazing to have that vision and to literally just execute and show some tenacity, go after the goal, and you're making it. That's fantastic.
So far, so good.
So far, so good.
I'm not there yet, but
wait, the builder will go bust again after I said that.
Well, unfortunately, I've put other structures in place to make sure that doesn't happen, but that's a whole other story. But,
so, all these projects that you mentioned, they're South London?
Yes, they are.
Of course they are, yeah.
Yes. That's why we're here, right?
That's why we're here, yeah, absolutely. So, South London again, that's great. And are you even looking north of the river?
Not actively. I think if the right sort of opportunities came up, perhaps on a joint venture basis, if the numbers work.
If you don't have to actually physically cross the river.
Yeah.
I did the other day. It was a terrible experience. So much smaller.
It's funny, my other half, she used to live in North London, I was South London, but managed to convince her to join me down south, and then we got married. The rest of
the bright side, yeah.
Yeah, but no, I would definitely do it. I would consider it. I think it's all about numbers, really. If the numbers work, if you can apply the same sort of model, and you've got the right risk management strategy in place, and you've got people who know that area can work and respond, then fair enough. So yeah, I'd be open to it.
That's great. So tell me, you're a Battersea man. What's your favourite part of South London then?
Yeah, I love Battersea because that's where I live. It's next to the river. It's really easy to get into town. It's easy to get down to sort of South London, Croydon area, where I'm doing some of my work at the moment.
Council tax.
Yeah, it's one of the best boroughs for council tax as well, and it's a great place to be. Unfortunately, prices are quite high there, but they've actually had seen a good correction there over the last couple of years. So perhaps becoming a bit more affordable if you want more space. But long term, we want more space, garden, outdoor amenity. So probably end up moving out at some point. But for now, it's working well.
It works well. Battersea's great. I love Battersea. So, would you recommend to anyone else investing down south?
Definitely. I mean, we've talked about the benefits and the pitfalls of investing in places which are further away from a risk management perspective. But I think in South London, especially further south you head, there's definitely areas of opportunity. We're seeing a lot of infrastructure improvements, investment in certain areas. I mean, I've mentioned Croydon as an area of interest. We're seeing a lot of interest there now, a lot more competition, and obviously house prices have gone up. But there are still other areas of South London which I think work. It's even if when you're going to the open market, if prices seem high, there's still deals to be done. You just need to be in a cash position with the right financial backing, whether it be through bridging with terms and principal or private investors, where you can react quickly to opportunities, and that's where the deals can be done, where speed of execution is going to work in your favour.
Good. Because speed, it's always a trade-off, isn't it? Speed and price.
Yeah.
Yeah, if you want to sell it quick, you're not going to get the best price. So
I mean, and that's definitely the theory of it, but I think in today's market we're definitely finding that people are still holding on to yesterday's values, but I think people it's starting to sink in now that there needs to be that correction. Vendors' expectations are starting to come down a bit just because of the political landscape and some of the huge uncertainties that are out there, which is concerning for a lot of people, and it should be for all of us. But as long as you have strategies in place to try and reduce your risk, and bear in mind that prices can drop further, factor that into your pricing, put enough offers out there, and eventually people will transact with you if you can demonstrate that ability to transact quickly.
Absolutely. And I think ultimately it's very important to realise that if you're producing an income-producing asset, that the value tomorrow is kind of irrelevant. As long as you've added enough value, you've been able to refinance the property, and you are in a position where you're getting a rental income of, say, £2,000 a month, your mortgage is £1,000 a month, you've got that £1,000 difference every single month as cash flow. You don't need to cash in on the asset, do you?
Yeah.
You don't need to sell it tomorrow. It's giving you £1,000 a month. Why would you sell it?
Yeah.
Even if it's halved in value, as long as the lender is not calling in the loan,
Yeah.
then why would you sell?
Yeah, that's
no need.
Great point with the lenders. I think the other thing as well I'm finding is that at the end of the day, if lenders and institutions have the appetite to lend on a particular proposition or a property, then if it works for them and their bank grade due diligence, then it's good enough. I think that's a test. It's a true test in itself.
Definitely. Well, let's wrap up there. And what I'd like to do is put your contact details at the bottom of the screen so people can get in touch with you. But for the listeners on the podcast, how do they get in touch with you?
Yeah, great. I mean, I'm on Instagram. Feel free to connect with me on LinkedIn. That's something that I'm trying to spend a bit more time working with as a platform. Instagram, ro.hmo, that's me, and ro Sharma on LinkedIn. That's the best way to connect with me.
Great. And I'll put that all in the show notes as well, so hopefully you can just scroll down to the bottom, click the right link, and get in touch with Ro through the link. So we'll bring it to a close. This was the Down to South London podcast. Thanks for tuning in. Ro Sharma, thank you very much.
It's been a pleasure. Thanks
See
very
you
much.
soon.